With a net worth of $400 million, it would be fair to say that Kevin O'Leary is a highly successful businessman and investor. Since 2009, he's been a main cast member on ABC's Shark Tank, where he's popularised the nickname Mr. Wonderful. Alongside his appearances on Shark Tank, Kevin is also a regular contributor to CNBC, where he provides finance and investing commentary, as well as hosting his new show called Money Court. Sometimes you can listen to other people's views on a particular topic, and what they say just really resonates with you personally. This is what happened to me when I listened to a few sound bites from Kevin O'Leary discussing his investment principles. What he talked about backed up my own thesis on investing, and he's someone that I really enjoy listening to when it comes to investing and creating wealth. Like myself, Kevin is a big advocate for dividend investing. So much so that he even has his own line of ETFs through his company O-Shares Investments. The ETF, ticker OUSA, is comprised of companies that provide dividends, stable growth, and low volatility. O'Leary believes that by combining these three important elements, investors can create a stable income-generating portfolio. To give you some examples of the type of companies Kevin invests in, the top 10 holdings of OUSA are Procter & Gamble, Johnson & Johnson, Microsoft, Home Depot, Verizon, Apple, Pfizer, McDonald's, Lockheed Martin, and Comcast. I hold 4 out of these 10 companies in my personal portfolio. So why does Kevin O'Leary love dividends so much? Rather than have me explain Kevin's philosophy and views, I think it's probably better to hear it from the man himself.
I learned years ago, Carl, that I don't invest in stocks that don't pay dividends. I'm old school, because 70% of the returns over the last 40 years have come from cash flow, from dividends, not from capital appreciation. So having looked at that as a student of the markets, you can't talk me into a stock that doesn't pay a dividend. Sorry. And as a result, I watch this volatility from afar. I hope you're enjoying it. My portfolio is like a chicken on a spit dripping cash right now. I'm very happy.
Interesting. How long have you had that rule, and do you just ignore some of the sales forecasts for some of these industries?
Look, you know, I learned it through a remarkable experience. My mother died 7 years ago, and she had a secret account. I always wondered where she got all this money from. Hid it from both her husbands. I became the executor. It had 50% corporate bonds in it, 50% large cap dividend paying stocks. It had been around for 52 years. Do you have any idea what the returns were on that? It beat everything. And I started to study that. She was not an analyst, but she had this intuitive feeling that she would never invest in anything that didn't pay her to wait. She sold me from afar, from heaven. I only buy stocks that pay dividends.
Wow, that is an amazing story, Kevin.
Yeah, it's true.
The Nasdaq is...
So let's pick up on some of the main points from what Kevin has said there. 70% of returns over the last 40 years have come from dividends, not from capital appreciation. This is a statistic that just can't be ignored. Reinvested dividends over the long term has been proven to generate substantial returns for investors time and time again. Also, at the time of the video, the panelists were discussing that there was a lot of volatility in the market, but Kevin was relaxed and unfazed by this, likening his portfolio to a chicken on a spit dripping cash. This is why I like dividend investing. When your portfolio goes up or down, it doesn't really matter, as you just focus on the cash flow that the dividends provide. We know that the market can be irrational and illogical at the best of times, but unless something fundamental within the company has changed, it's usually just short-term noise to be ignored, as you're not reliant on the market value of your holdings. If the market value of a stock goes down, then great, you get to purchase future income at a discount. Kevin goes on to give more reasons as to why he favours a dividend investing strategy.
If you look at the volatility in the market around names that don't pay dividends, they're extremely volatile because there's no cushion of yield. What's the value of a stock that never returns capital to its shareholders? I don't know, because the only way you can make money is if somebody else is willing to buy that position at a higher price for some emotional reason perhaps, or for some foresight that maybe the company will return capital one day. And I think of when you learn as an investor over multiple decades is the only thing that matters is free cash flow. That's it. There is no other reason to own a stock. And with that philosophy, it brings you into a place where you focus on a company's ability to generate incremental cash flow, because just owning a dividend-paying stock is not good enough. Because, you know, let's say we find a stock today that's paying a 3% dividend yield, and tomorrow, because its forecast for sales get cut in half, the stock drops by 50%. Now it's yielding 6%. I don't want to own that stock either. So my tests in this index that I've, you know, created with FTSE Russell looks at the balance sheet. Every year we test to make sure that the company is viable in its ability to generate cash. This is extremely conservative investing. This is for the long haul. These tools are not for, as you're suggesting, for spicy, you know, the hot stock du jour. I've done that. I've been there. You know, let the young legs do that. I have zero interest in that. I don't care what the hot new stock is. You know, when a company comes public, I won't own it either. It's got to prove to me over multiple years that it can continue to generate cash before it even fits into what I'm doing. So I'm really boring, and I like it that way. When I was 7 and my brother was 5, she'd take us to the bank with her, you know, because that's where you would buy bonds back in those days. You could actually buy the certificate with the coupons. Every 6 months you'd clip them off. She'd say to us, boys, never spend the principal, only the interest. I had no idea what she was talking about. That's all I do today. In my world, you never touch your principal. You adjust your spending habits, your gifts to charities, your use of capital based on how much you can generate from your portfolio. I view my portfolio and my trust and my positions as a chicken on a spit dripping cash. Everything has to generate yield, whether it's a fixed income position or an equity. It has to, the only reason it can be in my world is it's generating capital back to me. I take that, I disperse it. The family lives off that, the charities I've committed to. So I'm always looking for a company that can help me with my problem of generating more yield. Everything that, I mean, I can't even imagine buying a stock that doesn't pay a dividend. Why would you do that? What would be the reason you would do that? I don't get it. So to me, that means about 28% of the market, to me, is just speculation. A stock that doesn't pay a dividend is a speculation. It's not an investment.
I think that Kevin makes a number of great points here. Whenever someone makes an investment, naturally, they'll want a return on that investment. So for me, buying a stock that doesn't pay a dividend is like buying a house and leaving it unoccupied, with the expectation and hope that in a number of years' time, someone will come along and buy the house off me for more than I paid for it. It's just pure speculation. But why would you not want to rent that house out and receive an income from your investment? And it's that theory as to why Kevin and myself like dividend stocks. Buying stocks and just hoping that they increase in value just doesn't sit right with me. I associate hope with gambling, i.e. I hope that the horse I've picked wins. To me, hope isn't an investment strategy. Kevin O'Leary's mother had it right on the mark when she talks about never spending the principal. If you spend down your principal, you're essentially slaughtering the golden geese that lay the golden eggs. And that's a pathway to potentially finding yourself with no principal and no income further on down the road. With dividend investing, your returns come from dividends, not selling shares, so your principal always remains intact. Kevin goes on to talk about how he likes to utilise his cash.
Here's how I think of my money. Soldiers. I send them out to war every day. I want them to take prisoners and come home, so there's more of them. Your army, every soldier dies that you send out every day. When you have no soldiers, you're wiped out. That's the game of life.
This is an interesting analogy, and this is exactly what I want to do with my money. When I invest, I want cash flow. I want money coming back to me so that I can use that money to send out again and generate more cash flow. Over time, this compounding effect can really generate substantial returns. I did do a video discussing the powerful effects of compounding if you're interested. Kevin also talks about his philosophy further.
You remember back in the late 90s, I'll use one example, Toys.com. I was an investor in Toys.com. I went to zero, never made any money. And I grew a little 4-inch Charlie Munger on my shoulder when that happened. And he appears, you can't see him, but he's on my shoulder every time I'm getting pitched a deal like Lyft or Uber. And Charlie says only one thing. If it has no cash flow, just say no. And I have listened to my little Charlie ever since the late 90s, and I've been right 100% of the time. This company is valueless. It doesn't have any cash flow. It's a speculation. There's no different than putting your money down on red or black in Vegas than giving money to one of these losers.
When purchasing shares of a company, we need to remind ourselves that we're effectively buying a part of that business. To further elaborate on an earlier point, if you were to own 100% of a business that wasn't producing a profit, you would merely be speculating that one day you hope it would make a profit. Either that, or you hope to sell the business to someone else who hopes to make a profit themselves. So why wouldn't you apply the same principles to your own investments? If your investment isn't actually returning cash to you, then you're either just hoping that one day it does, or that you hope to sell it to someone else in the future. Either way, as we've discussed before, hope isn't an investment strategy. As Kevin puts it, if it has no cash flow, just say no. So we know that dividends are important to investors, but how do they affect the business?
No, I think dividends provide a certain discipline at the board level that's absolutely crucial. I love to use an example when I talk about dividends, when I teach these days. Yahoo. Think about Yahoo if you bought that stock at $200 when it was being put into the S&P decades ago. You've watched a turnstile of CEOs go into that company, I don't even remember their names anymore, suck out hundreds of millions of dollars, and shareholders have never received any return of capital through dividends or anything else. Had you taken those CEOs, Kelly, and simply said to them, we will gift you in escrow shares that pay dividends, and paid them $1 a year, how different would that outcome have been? They would have been myopically focused on generating cash flow and distributing it to shareholders, including themselves. That's the discipline of dividends. That's why it matters. The only thing that matters in investing is free cash flow. If a stock doesn't pay a dividend, it's simply poo-poo. That's it.
What about...
I think that what Kevin is saying here is really important. He's saying that companies that pay a dividend have to be focused on generating cash flow in order to satisfy their shareholders by paying a growing dividend. Consequently, a company that's able to generate large quantities of free cash flow is highly unlikely to fall into trouble. So effectively, this does reduce the risk in investing in that company. I hope that you found this video interesting and informative, and I hope it's given you inspiration and ideas for your own personal finances. If you have, please like the video and subscribe to the channel to make sure you don't miss any future videos. Also, let me know what you think in the comments section below. Thanks again for watching, and I'll see you in the next video.